Hello friends, welcome to my new video in the series of using AI for investing. Till the last video we completed a lot of topics which you can see tick marked in this image. Now we move to financial forensic analysis. Before we get into the prompting for this topic, let us see a few basics about this financial forensic analysis. Before I move further, let me quickly jump into the framework which is used for a long-term financial statement analysis, and let's see what the place the financial forensics takes into. So there are a lot of analysis which you need to do part of financial statement analysis, I mean long-term investing, and one of them is financial forensics. Why? We will see little shortly. There are many tools, whatever you're seeing on your right, there are many tools. Okay, this we'll discuss in detail. I feel you need to understand about financial forensics before getting into the prompting part. And now connecting back to my investment framework, I had shared this picture a couple of months ago about my framework, high level of framework, and you will see financial forensics are listed here. So why this is done? You always have a question whether the numbers can be trusted, and many people very illiterately say annual reports are of no use, the numbers are cooked up, it's stacked against small investors and so on. But my difference, there are ample tools to uncover the fraud or the misdoings by the company in their financial statements. So this is the financial forensics analysis which fits into my framework. Now let us get into the basics or what it is about. See, financial forensics is a very broad field and a specialized field where there's a mix of skills on accounting, auditing, and a bit of investigation skills to unearth financial frauds, legal proceedings, or money laundering. For retail investors like you and me, this is a very vast scope, and it is even beyond our academic knowledge what we might have on investing. So, how do I, as a retail investor, use it? So, the answer is ratios. See, as part of this financial forensics, there are a couple of ratios and models and formulas which are used to calculate the some numbers and gather inferences. Okay, these ratios, by using these ratios, we as retail investors can uncover a lot of inferences about the quality of the numbers behind the financial statements. Basically, these are statistical models which provides insights into accounting quality, possible bankruptcy, fraud, manipulation, and many other things which we'll shortly see it. But remember, very importantly, these are indicating only probable occurrence. So it is neither clean check to the company nor it is 100% fraud occurrence. You need to correlate with other inferences or other findings in the financial statements. So why you can use this ratio is the perimeter is only financial statement, means just by using financial statements, the annual report, balance sheet, income statement, and cash flow statement, you can do this analysis. So mind you, you are using only a very small or a tiny part of the bigger field of financial forensics. Now moving to the next slide, there are, I told you there are ratios, right? So these are the different ratios. Okay, but these are only a few of the different ratios. We are not going to master every ratio. These are very few, and these are most commonly used and can be directly derived from the financial statements. Each of these ratios have a different purpose, so which we will see in the subsequent slides. So as I told you, these are financial, I mean, these are statistical models, and how they, what to say, help you to uncover fraud. We will see taking one of the example, that is the Piotrowski score in the next slide. For our scope or for our use case, in the coming videos, we will see how to prompt and what inputs to give for these, for doing this analysis, for each of these analysis. Okay. Now let me take you to the sample of Piotrowski F score. Okay, this is a scoring system or a 9-point analysis where there is a score allotted for each of the criteria. There are 9 criteria where the company is evaluated, and for each criteria, 1 point is given. When the final score, if you see below, if it is anything about 8 to 9 is very, very strong fundamentals, and 0 to 3 is distress. So what are the points like profitability? Cash flow must be greater than 0. Return on assets must be greater than 0. Then the delta return on assets, that is between the last and this year, they should be improved year on year assets. Then the cash flow must be greater than net income. So like that, each of these criteria is targeted towards a particular uh, point in the financial statement. That is quality of earnings, improved liquidity, no dilution, improved profitability, and so on. So based on this score, based on this analysis, as I told you, each of these parameters will give a 0 or a 1 rating, and that will decide the total. And you can arrive at an inference whether it has a strong fundamental or a weak fundamental. Like this, each of these have a different approach, and we may not be discussing each of it now. In the respective videos where I discuss prompting, I'll just introduce you these numbers or the ratios. So coming back, so there are so many ratios we saw, right? And we discussed that each of these ratios or these models are focused on a particular area. For example, Benish M score, that is used to identify earnings manipulation. Then the Altman score, that is used to identify possible bankruptcy. Then quality of earnings ratio, whether the earnings are accounting profits or real cash. So likewise, each of these, like we just now saw this Piotrowski F score, that gives the value and the financial strength of the company. And based on the focus area, what is the use case? And based on the use case, what is the primary application? Maybe I can share the slides and maybe along the tweet. You just have a quick look. And these ratios will models, so these ratios or models will have some output values. A greater or lower value will indicate a inference, like Altman Z score. If it is less than 1.8, it is a high risk of bankruptcy. And that Piotrowski score we saw, a score from 8 to 9 is strong, and anything 0 to 3 is weak. So other ratios are Montier C score, Sloan's accruals, and so on. There is one Lev Tyagarajan 12 signals. This is something similar to Piotrowski score, where there are around 12 parameters which are evaluated and ratings given. Higher the signal, stronger the fundamentals. So you need not worry much of these details now. In the respective prompting, when we go through the subsequent videos, I will introduce those videos first and then go to the prompting part. So summarizing this, I told you there are different models or ratios and where they're used. For fraud detection, these are the different tools used. For bankruptcy, Altman score, accrual ratio, and quality of earnings. Then stock selection, fundamental strength. These two stand out, like Piotrowski score and Lev Tyagarajan signals. So likewise, there are ample use cases or ample means to or areas of focus which will throw light on the quality of the numbers used, quality of management, etc. Okay. And now what inputs do you need? See, there is nothing great. All of these, whatever we saw so far, can be calculated only with the financial statements, what you have in hand. You don't need anything else apart from it. So if you take Benish M score, it needs only balance sheet and P&L. Altman score needs only balance sheet and P&L, and so on. There are all the three financial statements except the last two or three, where for this Jones or modified Jones model, you may need multi-year balance sheet, financial statements. And the last Tyagarajan 12 signals needs one or two analyst estimates. These are the only points which needs a outside, what do I say? Outside the financial statements, you need one or two inputs. That's all. So as I close this video, let me complete that, conclude that we are going to see promptings for each of these financial ratios or model, how to gather inferences and make decisions for our stock investing. Bye till we catch up the next video.